You're taking a look at some of the post-election rally, and there was a bit of a slip up towards the end of last week. You've got a lot of potential retirees or people who are trying to figure out, okay, what does this mean in terms of my money management right now? Should I be locking in gains or should I be adding into positions? What's your analysis?
Well, it's no question that the economy has continued to do well, do even better under the Trump election at this point. GDP is in a good place. Inflation's coming down. The Federal Reserve has already lowered rates. And of course, those are all just tailwinds for continued growth through the rest of 2024 and even in 2025. The challenge, though, that I'm worried about is that I don't want retirees to get over their skis. We're in the honeymoon phase. We're in a euphoria right now. And a lot of times when we get into this euphoria and crypto's going up and the stock market's rallying, and it's very easy to think, well, I should be in. And then let's go take everything and get in the market. The challenge is that the market is still a dangerous place to be. And it can turn and bite you at any point in time. And so the reality is, if you get out over your skis and we have another major market crash, like we've had two crashes greater than 50% over the last 25 years, that could happen again. And I don't want you thinking, or retirees thinking, that the market is a safe haven. It's not, but a lot of people start thinking that. So you've got to have a plan where you can stick with your risk tolerance. You have to know what your risk tolerance is. And make sure that you don't make decisions to violate that plan just because everyone else is in a honeymoon phase. That'd be a mistake.
So the markets have, and as they've been in this honeymoon phase with the run up and kind of the sense of euphoria that is certainly permeated, and we see that in some of the new recent highs and some of the new climbs higher as well. But more largely, once we get into the next administration, there have been some calls from economists who are concerned about some of the hard pivots, the big cuts that have been talked about, and the economic impact as well of everything from cutting $2 trillion from the budget and finding areas to make cuts, all the way to mass deportations. How would that pass through to the economy from your sense, and then thus be evaluated by the market?
Yeah, so we have to remember that all the rhetoric leading up to an election and then post-election, it doesn't mean that that's all going to become policy. Now, if we wind up having a sweep in Congress and in the Senate and so on, then yeah, there's going to be a lot more flexibility. The other concern that I have, just a little concern, is that this is Trump's last year or his last 4 years in office. So it allows him to be a little bit unfiltered, a little more unfiltered than maybe he is, and maybe to push through policies on a little harder, in a little harder path than maybe he was before. And there are some negatives. You mentioned immigration. There are a lot of highly skilled, highly paid immigrants that are in this country as well too. We've had a labor shortage in this country for a long time, and if we start mass deportations, that labor shortage could worsen and increase the cost of wages, which then it gets passed on to the consumer through inflation. You got to raise the price of your goods and services if you're going to pay your employees more, and you might have to pay your employees more if there are less employees because of the deportation. The tariffs is another issue. Trump talks about the fact that the tax cuts is going to offset the tariffs, but is that really true? Ultimately, if you charge more for goods and services coming in, that's going to have to be passed on to the consumer and could wind up resulting in inflation as well. So it's not all rosy. And you're right, there's definitely going to be some bumps in the road once we find out what his actual plans are and what he can actually get passed through. It's not all rosy. We're still in the honeymoon phase, but you and I both know that after the honeymoon phase comes the marriage, and that's a lot of work.
Well, there's a lot of retirees out there that may already have been married for decades at this juncture, and they're trying to figure out, okay, how do we make sure that we're just riding off into the sunset on the gains that we're trying to lock in? What is, with everything that we've laid out, your investment strategy for retirees?
So I like to focus on investing for income. Most retirees need to get income out of their portfolio. And if you're invested in stocks and mutual funds, primarily growth-related investments, the only way to get 3 or 4 or 5% a year out of your portfolio is to start selling shares. And if you sell shares, then eventually you have the worry of running out of shares, running out of principal before you run out of life. And that's what we don't want to happen. But if you invest for income in the form of interest and dividends, you can spend your interest and dividends without ever selling a single share. And that means that you don't ever have to worry about your money running out. It's the difference between eating the chicken or eating the eggs. If you're cannibalizing your principal and you're selling shares to get your income, you're eating the chickens. But if you're living off your dividends and interest, you're eating the eggs, and you never have to worry about those eggs continuing to come in. So I like to focus on that for people that are retired, because it makes your retirement more secure. You know you have the income. You can invest in things that you can count on the income. You can never count on growth. If you have a portfolio, we don't know what that portfolio is going to be worth in 2 years or 5 years or 10 years. But if you have dividends and interest, you can count on it. And there's a lot of retirees out there that could afford to take some chips off the table. They've done really well over the last decade and a half, and now they're going to retire. A major crash would kill them. Living off of interest and dividends would give them a much greater chance of a secure future. So that's the focus that we go with retirees.
Anthony, I knew I could always count on you for either a really good metaphor or a really good analogy. You delivered just that. Anthony Saccaro, who is the president of Providence Financial and Insurance Services. Thanks for taking the time.
Thank you, Brad.